And I don't want to tell you like too much about his personal journey and where he's heading and what he's doing, but let's just say he's kind of a Fed insider in a way. He's a guy that he knows a lot of people. Let's just put it that way. So he's a good person to talk to, especially ahead of the FOMC. So make sure you're listening to that. And Mark's one of those guys. Every time I go to New York, he's like, "Come by my house, come have a drink with my wife and I." And I've failed to do so, and I really want to do that one of these days. Anyway, look at some of these yen pairs, and look at the commodity. Like here's the Kiwi yen. We're above the 618. Aussie yen. Aussie yen's threatening. I mean, this thing breaks out, and I'm not saying it will. I'm just saying that if we get much above that 87 yen level, it's gone. Canadian yen, I mean, we're trying to break out of this triangle. I mean, they all look like they can really rally here. And then you look at all the commodity currencies, they look extremely bullish. And I'm gonna leave you guys with one gimme here. Well, you guys saw it in the chat room, but that's a AB equals CD Aussie.
Okay.
78% retracement, Gartley pattern, reversal, higher. So again, if you were in the ForexAnalytix chat room, as soon as I got up, I'm like, I'm gonna get long some Aussie US dollar, because that was in the ForexAnalytix chat room, because I'm like, well, we respected that, and if you didn't know that, well, then you could have gone over here.
Webinar online.
And known from, well, that's today, excuse me. That would be yesterday. We were looking for a move down to, 71.70. And the overnight low of the Aussie dollar was 71.65. So, and in the markets, close works just like horseshoes and hand grenades. So,
close enough for government work.
And close enough for government work. So guys, make sure you take advantage of the trader funding program, because when you join the trader funding program, you actually get ForexAnalytix Premium for a certain period of time with your assessment. This way you're not trading alone, because that's the last thing we want for you. We want you trading with a community. So if you're curious, just watch this 2-minute video down at the very bottom of the trader funding program site. All right, Dale, I'm going to let you take over. Ryan, thanks for being here this morning. I don't know where the rest of the team's at, but
it's all right. There are 3 of us.
It's this 2 weeks before the time change happens. It kind of screws everybody up. So,
well, I want people to think about that haven't subscribed yet. Yes, there's a cost, and weigh that against the opportunity cost.
There you go.
And that's a solution. So thanks, Blake. Good hunting today. I'll be talking to you later during our meeting. And all right. So Arnold Venter, welcome back to F.A.C.E. How are you, my trading warrior brother? How's it going? Are you hooked up?
I believe so, Coach. Can you hear me?
You are. Got you, Arnold.
Great stuff. Great stuff. Great to be here. Thank you so much for having me.
Yeah. So what's on your mind? There's so much happening. I'm curious what you have on your radar. Do you want to share the screen, Arnold?
Absolutely. Absolutely. Give me a sec to just to share this one.
Where do you trade from again, Arnold?
From do you mean where I'm staying at the moment?
Yeah, where you're
from South Africa, actually.
Okay, that's what I thought. Okay, so a couple of the guys here do some rand trading. The share screen is at the bottom, that green box.
There we go. There we go. There we go. All right, this should be the one. Let's see.
Yeah, it's coming up.
Okay, perfect. Yeah, so I mean, there's so much going on right now. Coach, with Ukraine and Russia. It's been so many developments in the background. We've obviously got it seems like everybody has forgotten about the cyclical aspect of the markets as well. Going into this year, the markets were already expecting a slowdown to take place in the US as well as the global economy.
Because of the curves?
Say again?
Because of the yield curves?
Yeah, and growth has been slowing for some time on a rate of change basis, at least. If we look at a 6 month smooth rate of change, the reason why I like to use the 6 month is just it strips out a lot of the noise, especially in the shorter time frames. And this chart here at the top left hand side, growth has been slowing for the last couple of months, and that was expected to already accelerate going into this year, not because of necessarily the economy expected to do bad, just because when you're trading at these types of levels in terms of growth, then mean reversion from purely base effect reasons is obviously going to be high. So growth was expected to slow. Inflation was expected to slow as well, and obviously more recently that's just not been the case. And I think this chart here at the right hand side of the bottom is quite interesting. If we take a look at blue, that's our inflation CPI, and we can see every single time that we've had a shock move to the upside, the result of that has been a slowdown in activity. Now we've already started to see quite a sharp slowdown in the ISM numbers if you take a look at the manufacturing and the services. So I think from a cyclical point of view, that's kind of been pushed into the background because of what's happening on the geopolitical side. But I think that's going to come back into focus when we start seeing some of these incoming data points, sequentially turning lower and basically forcing the Fed into an even more difficult situation. Because right now, the market is comfortable pricing in where we're at right now. I think 7 hikes, close to 7 for the Fed. I think they're going to struggle getting there if they need to discount for what's going to happen on the growth side of the economy, especially with stagflation risks now rising as well. So with all of that said, I think the cyclical part is going to come into focus in the next couple of weeks, next couple of months. Right now, though, I think there's only really 2 things we need to be focused on, apart from the geopolitical stuff, and that is, of course, what's going to happen with the FOMC. I think from a short-term perspective, I'm probably going to take a contrarian view on this one, but I'm actually looking for some dollar softness this week, especially post FOMC, potentially yields as well. Not from a medium-term perspective. I think medium-term, the dollar is still bullish if you have an environment where you're expecting or growing risks of stagflation, where the cyclical component is slowing down. When you've got war breaking out in certain parts of Europe, then obviously the dollar, there's going to be a lot of upside. And even though the markets have priced in quite a lot for other central banks, the Fed is the driving engine when it comes to central banks. So obviously, if they're expected to hike 7 times, there's been a lot of support for the dollar. But I think
they'll start with a quarter.
I think so. I don't think they're going to go half. I think Powell was pretty clear in his hearing that he did, where he said that he'll opt for a 25. Inflation is close to 8. So there is reason for them to go big, but right now they've said many times they don't want to scare the market, especially when you've got all of the geopolitical stuff in the background. I think if they do come up with a half point, they would undo a lot of what they've did recently. Because think about it this way, even though equities have plummeted quite a lot, but considering that we have a war that broke out between Russia and Ukraine, considering that from a cyclical point of view, the economy has been slowing and recent data has been slowing much faster, considering the fact that we've got growing stagflation risks and the fact that the Fed is expected to hike 7 times, equities haven't done too bad if you think about that whole context. Yes, we're down quite a lot, but with the amount of leverage in the system, with everything that was expected to happen from a fiscal cliff, and the list goes on.
Sounds like you think there's value right now after this correction. What are you looking to buy?
I think short term, Coach, it's going to be one more low. Dovish Fed reaction moves, not because I think they're going to come in dovish. I think they're going to come in hawkish. I just don't think they're going to be hawkish.
Not as hawkish.
Yeah, to see a sustained move in the things we've seen recently. So, for example, the main one that I'm focusing on, dollar, I'm currently already short this a small bit, is because of peak hawkishness. So, if we consider what's priced right now, 7 hikes, realistically speaking, where do we think the dot plots will be able to land? I think if they come in 5 or 6, that's already going to be a big jump from where they were December. And the further we get away from 7 to the downside, the markets could see that as being less hawkish, even though that would still be hawkish. Going from 3 to 5 or 6 will be a big jump in their books. But when you've got 7 hikes priced, I'm just not sure whether they're going to be able to, to jump over that very high bar right now.
Okay, so with your narrative that you've been talking to us about, you're looking for dollar correction. What else?
Dollar correction, yield correction as well. Yields have been one that's been a big challenge for me, because I'm short yields, or long bonds. The other way around.
That's very contrary. I agree. But don't you need a U.S. dollar yen top? Would that be helpful to you, or do you don't even look at that correlation?
The thing, I think the challenge for me about the yen right now is that it's not just been a yield story.
It's been an oil story. Some people say it's an oil commodity story. Others say it's an interest rate story. What do you think? All of the above?
Exactly, Coach. I think if you look at the size of the move, there's been times in the past couple of weeks where, if we take a look at that yield correlation, it's definitely still there, but there has been a few dislocations a couple of times, and I think to just blame it on yields would be wrong right now. I think it's definitely a commodity story. I also think that the fact that, yes, equities have come down quite a lot, but when you've got an environment where there's potentially going to be funding stress. I mean, if we take a look at credit spreads, they've been on the rise. If we take a look at risk-free 3-month dollar funding rates, they've been on the rise. Interbank rates have been on the rise. All of those things are normally more, dollar funding stress related. So I think the dollar has just enjoyed a lot more safe haven inflows compared to the likes of the yen, apart from all of the other reasons. So I wouldn't say that dollar downside and yield downside would necessarily make me want to short dollar yen.
Okay.
I would much rather like to be long something like pound. I know that's a little bit contrarian right now as well. But if we consider what's been priced out of sterling recently, if we take a look at this chart, this is just a basic index chart for sterling versus all the majors, and the amount of downside that we've seen in this,
especially the last few weeks when euro pound exploded.
Yeah, so, I think it was crazy. So I think some short-term mean reversion, pure just tactical mean reversion in pound dollar makes sense. But I have to say, we are still bullish euro sterling as well. So I would use any strength we potentially get out of the Bank of England this week. I would like to use that as an opportunity to get back in on euro sterling from more attractive levels, because I think medium term, if you take a look at, surprisingly, with everything going on, growth differentials are sequentially turning in favor for the euro versus the UK, if you can believe it. Growth differentials are looking interesting for euro sterling. And apart from that, again, if we consider what's been priced in for the Bank of England, I think it was very telling at their February meeting when they came out, where they said, even though the statement was very hawkish, with 4 members voting for a 50 hike, and we had, inflation predictions up to above 7%. That was very hawkish, but they deliberately tried to talk back at the press conference, trying to really, come across as dovish as possible. And that saw the pound really failing to rally. Now, when you've got a currency that's pricing in, close to 7 hikes, or sterling market is pricing in close to 7, and the currency can't rally, that tells us a lot about the underlying sentiment. Yeah. So I think from a surprise potential, if you think what the ECB could still do and could potentially do in the next couple of months, I think there is still some surprise potential there as well. Where I think from a sine curve point of view, Coach, I think the Bank of England is now at the top of the sine curve, probably looking on its way down. from a surprise potential, while we have the ECB at the bottom of the sine curve potentially looking, making its way back to the upside. So I think there's some relative attractiveness there for euro sterling. But
the technical case is compelling. I mean, the week it put in after cleaning out major support, that 82.20, and putting in, I believe, an engulfing candle to the upside on a weekly. Pretty impressive.
Very, very, and that's despite despite everything going on with the euro. That was quite impressive. I think, it's also massively oversold. It's been oversold for quite some time. We moved into that major technical support, like Coach said, at around 82.80. I think the fact that we couldn't stay below there, I think that speaks volumes of where I think this goes in the medium term. Okay.
Anything in the commodity arena that you're paying attention to? The precious metals, oil, the headline grabbers, Arno.
Coach, when it comes to these headline grabbers, the volatility in these things right now is just, it's too much for my liking.
Great answer. Okay, great answer. Some people, would have a hard time saying, what, Dale's just too wild for me. Because it's like you're weak, you're afraid, you have fear. What it's wisdom.
Coach, I'm gonna go with wisdom on this one. It's just
anytime people go.
I think the embedded vols is just crazy. If we take a look at OVX, the implied vol for oil. Trading at 65. For me, that's the two-way volatility will just chew you up either way. So what I normally tell our subscribers when I look at a move like this or implied volatility like this is that it goes both ways. So if you're lucky enough to catch it when it goes down or up, you can make a quick buck. But if you get caught on the wrong side of a heightened volatility move, your luck eventually is going to run out. Unless you were, long from months ago or weeks ago from a medium-term play. But in the short term, the appetite for trading this is just, it's very, very low right now.
Nice head and shoulders top measures $80. And we're almost there. People can't believe it.
It's been crazy. Oil it's been, commodities in general. The thing about these moves is that if you don't catch it on the way up when it goes parabolic, it's best to stay out. And everybody's trying to catch the flush. But if you don't, I don't know, it's just too dangerous. I
actually used these ETFs because I was afraid of using futures. So
that's a good option, Coach. I can see that. That's much better.
And I'm kind of an older guy now. So,
no need to ramp the blood pressure unnecessarily.
I can't take the pressure anymore. No, go ahead.
need to keep it as peaceful as possible.
I trade only FX trades that the ARP approves, which is the American Association of Retired People. So retirement. Ever been to a retirement dinner for a trader?
I haven't, Coach. I haven't.
No one has. Anyway, I just wanted to see if you were the exception to the rule, but
definitely not.
Okay. So, what about your own currency? It's kind of it's a commodity currency. Is there a pretty tight correlation with gold price and the rand?
Yeah, Coach. Let me grab a chart here. There's actually a few of them. The three that you always want to keep on the radars is gold. The biggest one is actually platinum.
Okay.
And then there's also iron ore. So those are the three biggest exports. And I basically have just a little proxy for those three. It's not weighted, so it's not going to be as accurate. But from a general basis, you would expect your dollar ZAR to be correlated with those three commodity-based currencies, with those three commodities rather. But there's other things driving it, of course. If you take a look at the recent move, We had massive, of course, massive move to the upside in both platinum as well as gold, as well as iron ore, but we didn't really see the dollar ZAR move. So it's not as good as something like CAD and oil, even though that's also been hit and miss recently. But it's definitely worth keeping on the radar. But when it comes to the ZAR, coach, for me, it's more of a long-term structural sell when it comes to the ZAR. There's just so much
because of the politics.
Absolutely, the politics, the economy. I mean, to give coach an idea, where the world was growing at solid rates and expecting solid rates this year, going into the year, we were expecting to underperform most developed market economies, and that's not because there's no potential. It's just the policies is just not conducive for a growing economy. So we've been very reliant on commodities, and when you get these types of spikes, you can see a little bit of upside, which is why dollars are moved lower. But I think the fact that after this type of move, you didn't see more appreciation, I think that speaks volumes of the structural view for the ZAR, which in my opinion remains lower.
Okay, Ride the Curve wants to know why the Rand is designated ZAR.
It's actually the Republic of it's South Africa, but it's actually Zoit, so it's with a Z back in the day, so that's why it's the South African Rand ZAR.
Okay, great history lesson. Is it hard for you to have conviction about most things? But you have a narrative you're ready to play on. You're already positioned in front of the Fed. Let me ask you this. If the Fed only goes a quarter, if the Fed went a half, you would expect initially a positive dollar reaction, right? Do you think do you think the market, that the dollar is going to sell off on a quarter rate hike?
Yeah, I think what I would like more is if we see a little bit of a pop higher first, so maybe a little bit of a knee-jerk higher, and then I would fade any strength coming out of that. If we get weakness off the bat, I mean, great. That's going to move. That's going to be moving in line with the expectation. But I would prefer a little bit of a rally, sucking in some buyers and then fading that strength going out of it.
Would 94 be a reasonable downside target for a correction in the dollar here?
Coach, I'm not sure whether I'm even going to play it all the way to there. I mean, it could go. We've been stretched for a while, I think.
It looks like that is a very important low that it held that previous double top last night for me at 97.76. So under there, wouldn't you think we could get a pretty good flush?
I think so. I think if we break and close below 97.70, I think next stop's definitely 96.90. We might find solid resistance around 95.90 again. I think that was a really good area. We've also got trend support coming in from that level. I think it's more going to be a case of I think it's more going to be a case of how all the other currencies perform as well. If we get any major escalations once again coming out of the geopolitical side, and that's obviously going to be a factor to watch. And if the economy starts to really slow down rapidly, I do still think that's more of an upside potential move for the dollar, because it is normally more inversely correlated with global growth as well as US growth as well. It's counterintuitive because slower growth is a slower Fed, but the dollar it acts differently compared to other currencies if you think about the dollar smile theory. So
I think that we just something I think is happening, and it's subtle, that we're going back to a weak dollar would actually be good for the S&Ps.
Yeah, I think so. I think so too, Coach. I think if the economy, I mean, I don't know how far a Fed put. We're probably miles away from a Fed put at this stage. That would have been a saving grace for it. But I think if the dollar can see some decent downside, I do think it should be supportive of the equity space as well. Again, depending on how fast we slow and how long the Fed takes to pivot away from that. I mean, they're in a very tough spot right now with where inflation is at.
Yeah. How would Joe Biden's in a tough spot?
Yeah, absolutely. Absolutely.
It makes Paul's job about, oh, should I move Fed funds? A little easier to worry about Fed funds and, you know, the doomsday clock anyway. So I'm glad all I have to worry about are candlesticks. And
that's true, Coach. That at the end of the day, I would rather fight that battle.
yeah. So, and you brought some clarity today, Arno. So, you know, I'm really glad that you're in the rotation.
Thank you so much, Coach. There's one more slide I wanted to show. I actually forgot about.
We have time.
Speaking of the dollar as well, is this one here, which I thought was quite interesting. This was research done by JP Morgan a couple of weeks ago, where they said that they, based on the last 8 cycles that we've had, out of all of them, in the 6 months running into the first hike of a hiking cycle, the dollar normally appreciated. But in all 8 of those cycles after the first hike, the dollar saw depreciation. Now, again, you know, I'm not saying history is going to repeat itself, but when we add everything together, so firstly, looking at, you know, peak hawkishness for the Fed right now, looking at a price action that is very clearly very bullish going into this week, and then, you know, looking at something like that first hike blow off potentially, I think there's a lot of reasons to think this comes lower before it goes higher again.
All right. What a very great narrative backed up by both fundies and techs. Strong case. You rest your case here?
I do.
Could I put it out to the jury?
Absolutely.
Who agrees with Arno? Raise your hand. Give me a Y in the box. I know there's a bunch of you watching this. Paul Landon, yep. Anyone else? Amash, you may want to change your mind. You have too much company here, man. Anyway, it's the first time I've done a poll.
Coach, now I'm starting. I'm going to reverse it now. I'm going to start. I'm going to be I'm buying it back. I'm buying it back.
All right. I just get nervous when people agree with me. What can I say? I'm always looking for conflict, you know. So
and I mean, you don't want to be following the crowd. So maybe, but you know, maybe we're just looking at a very
hey, we all could be right.
That's
we
true.
all could be right.
So well-informed crowd.
It was right to have you here before the Fed and get this view on the dollar. Really appreciate your giving spirit, Arno.
Really appreciate you having me, Coach. Always a pleasure.
All right, everyone. And the best way for people to follow you?
Coach, they can find me on Twitter at ArnoVenter9, but they can also, you know, catch us at Financial Source. Our Twitter handle for that is FinSourceCo. Or we've got the YouTube channel, Financial Source, or the website, financialsource.co. Any one of those avenues, they'll be able to reach us.
I have a great guest suggestion for you on your YouTube channel.
Yes, Coach?
Me.
I would love, I mean, we've never done an interview before. I would absolutely.
Oh, okay, well, stretch your wings, buddy.
I would definitely consider that, Coach.
All right. All right. Arno Venter, everybody.
Coach, thank you so much.
Arno.
Really appreciate
it. Good hunting. Good luck on the Fed tomorrow, buddy.
Thanks, Coach. You too.
All right. My trading warrior brother. See you guys later. Thank you, everyone. Turnaround Tuesday. Good luck today. And you could be with the team in 18 minutes for the morning edge. Thank you, Paul. Thank you, Alexander. Thank you once again, Arno.
Thanks, Coach.
All right.